Welcome back, my friends. The news today is that OPEC Plus cuts offset by booming U.S. oil production. U.S. oil production is predicted to hit 13 million BPD in September, matching the record output from November 2019. Major companies including Chevron and Exxon reported record production in Q2 despite fewer active drilling rigs. The EIA anticipates record U.S. crude oil production for 2023 and 2024, with the U.S. leading non-OPEC Plus production growth. U.S. shale frackers are now giving OPEC Plus a real run for its money with record production in 2023. Are U.S. oil frackers finally getting out in the field and getting their rig counts up? Is U.S. oil production capacity finally going to reach its potential? What does this mean for consumers? What does this mean for oil companies? What does it mean for the U.S. economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Despite the fact that U.S. oil producers are now deploying the lowest number of drilling rigs in more than a year and a half, America's crude oil production is set to hit a monthly record in September, at 13 million barrels per day, BPD, according to estimates by Rystad Energy. Production growth has slowed due to the discipline U.S. shale producers have shown in the past 2 years, but a slower increase still means that output is headed higher, the energy research firm says, as carried by the Wall Street Journal. The expected monthly record in September will match the record output from November 2019, the only other month in which U.S. production hit 13 million BPD, just a few months before the pandemic crippled demand, sank oil prices and led to production cuts across the board. U.S. crude oil production is set to increase even more until the end of the year, with October and four-quarter output estimated to average 13 million BPD 13.1 million BPD, according to Rystad Energy's analysis based on regulatory filings, satellite imagery, and pipeline flows. Even at a slower pace, American production is growing and offsetting part of the OPEC Plus cuts, although the extended Saudi and Russian supply reductions are set to tighten the global oil market more than previously expected. U.S. shale production is not growing as fast as before, Alexander Ramos-Peon, Rystad Energy's head of shale research, told the Journal. But it doesn't mean that shale has to decline. According to Ramos-Peon and Rystad Energy, all signs point to still growing U.S. shale, although growth is still slower than before COVID. Despite the loss of active drilling rigs, shale firms are producing more oil and gas and have even exceeded some skeptical projections from earlier this year. Last week, the total rig count fell to 630, per the latest Baker Hughes data, the fewest number of active drilling rigs since February 4, 2022. The number of oil rigs fell by 8 last week to 507, down by 114 so far in 2023. Yet, large companies, including Chevron, Exxon, ConocoPhillips, and Pioneer Natural Resources, reported record Q2 production in the Permian or raised full-year 2023 guidance, or both. Pipeline operator Enterprise Products Partners is getting upbeat messages from producers about activity, Tony Chovanec, VP Fundamentals and Supply Appraisal, said on the midstream operator's Q2 earnings call in early August. Efficiency in operations and capital expenditure is now king in the shale patch, and companies are trying to prove this by having longer wells drilled. The Energy Information Administration, EIA, slightly raised this month its projections for U.S. crude oil production this year and next, and expects annual output to set records in both years. U.S. crude oil production is seen averaging 12.78 million BPD in 2023 and 13.16 million BPD in 2024, up from 12.76 million BPD and 13.09 million BPD, respectively, in the August short-term energy outlook. The U.S. is also set to lead non-OPEC Plus production growth, which is expected at 2 million BPD in 2023 and at 1.3 million BPD in 2024, led by the United States, Brazil, Canada, and Guyana, according to the EIA. So far this year, higher crude oil production from countries outside the OPEC Plus alliance has managed to offset part of the OPEC Plus cuts, the International Energy Agency, IEA, said in its closely watched oil market report for September. But from September onwards, the loss of OPEC Plus production, led by Saudi Arabia, will drive a significant supply shortfall through the fourth quarter, the IEA said. For those of you not familiar, fracking, short for hydraulic fracturing, is a method of extracting natural gas and oil from shale rock formations deep below the Earth's surface. The process involves drilling a well vertically and then horizontally into the shale rock formation. Once the well reaches the desired depth, a high-pressure mixture of water, sand, and chemicals is injected into the well to fracture the rock and release the trapped natural gas or oil. The sand injected into the well is used to prop open the fractures, allowing the natural gas or oil to flow more easily to the surface. The chemicals added to the water help to reduce friction, prevent bacterial growth, and dissolve minerals in the shale. U.S. crude oil output is up 9% year over year, blunting OPEC's efforts to keep supplies low in a bid to goose prices. There is little doubt the U.S. shale patch is largely responsible for keeping oil markets well supplied and oil prices low. Rystad Energy has estimated that whereas OPEC and its allies have announced cuts amounting to around 6% of 2022's production, non-OPEC supply has made up for two-thirds of those cuts, with the U.S. accounting for half of that. Luckily for the shale patch, improving drilling and cost efficiency not only means they are able to squeeze more for less, but they are also able to eke out a profit at much lower oil prices. According to J.P. Morgan, U.S. drilling and fracking costs have declined 36% since 2014, significantly lowering the break-even points of many producers. For instance, JPM points out that increased efficiency means AOG resources, for example, can earn as much from oil priced at $42 per barrel today as it would have from $86 per barrel in 2014. In contrast, Saudi Arabia reportedly requires about $81 per barrel to balance its books. The U.S. shale revolution dramatically reshaped the world energy markets. The shale boom was one of the most impressive growth stories, from takeoff in 2008 to the Permian stealing the mantle from Saudi Arabia's Ghawar as the world's highest producing oil field in a little over a decade. Overall, Reuters has estimated that U.S. petroleum production is at least 10 to 11 million BPD higher than it would have been without horizontal drilling and hydraulic fracturing. Unfortunately, the shale patch has lately been struggling to ramp up production due to a litany of challenges, including pressure from investors to boost returns, limited equipment and workers, as well as a lack of capital. But shale giant ExxonMobil is now betting that shale producers can double crude output from their existing wells by employing novel fracking technologies. First off, the company is trying to frack more precisely along the well so that more oil-soaked rock gets drained. It's also looking for ways to keep the fracked cracks open longer so as to boost the flow of oil. There's already a proven technology for oil producers to return to existing wells and give them a second, high-pressure blast to increase output for a fraction of the cost of finishing a new well: shale well refracturing. Refracturing is an operation designed to re-stimulate a well after an initial period of production, and can restore well productivity to near original or even higher rates of production, as well as extend the productive life of a well. Refracking can be something of a booster shot for producers, a quick increase in output for a fraction of the cost of developing a new well. While refracturing has never really gone mainstream, the technique is seeing higher adoption as drilling technology improves, aging oil fields erode output, and companies try to do more with less. According to a report published in the Journal of Petroleum Technology, new research from the Eagle Ford Shale in South Texas shows that refractured wells using liners are even capable of outperforming new wells, despite the latter benefiting from more modern completion designs. JPT also estimates that North Dakota's Bakken Shale straddles some 400 open-hole wells capable of generating in excess of $2 billion if refractured. AA refrac can be up to 40% cheaper than a new well and double or triple oil flows from aging wells. Refrac makes a lot of sense in the current inflationary environment. Back in April, Texas shale producer Colin Petroleum Company revealed that frac sand, drill pipe and labor costs have increased drilling and well completion service costs around 20% year over year. Colin and Hess Corporation, both of which drill in North Dakota's Bakken Shale, have been forced to hike capital spending budgets over the costs, with Colin adding $75 million to its original budget while Hess added $200 million to its spending. Another key benefit: refracs do not require additional state permits or new negotiations with landowners. They are also less disruptive to the environment because well sites already have road access. Considering inflation, supply chain issues, and rising wages, now is a great time for operators to start looking at wells for refrac opportunities. Matt Johnson, CEO of energy consultancy Primary Vision Network, has told Reuters. Refracks have also demonstrated higher recovery rates. Fracking has been controversial due to concerns about its potential impact on the environment, such as water contamination, air pollution, and seismic activity. Additionally, there are concerns about the potential contribution of natural gas extracted through fracking to climate change due to methane emissions during the extraction process. Fracking in the United States has seen a decline in recent years for several reasons, including: overall, the decline in fracking is likely a combination of factors, with economic factors playing a particularly important role. Global energy reliability concerns are triggering a surge in oil and gas investments. But this uptick is only temporary, and service companies should capitalize now before the focus returns to the energy transition. Of the $140 billion growth, shale production attracted most of the limelight with an additional $80 billion increase, as activity climbed 30% and pricing for oilfield services jumped nearly 50%. Offshore production accounted for $40 billion in growth, while other onshore activities expanded by an additional $20 billion. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.